I think OPEC is really making a strong effort to rebalance the market. They have a one shot at rebalancing the market. I don't think they can do this every year. So they're going to really try to bring down inventories. OPEC has some pretty clear targets. They want to have inventories down by around 300 million barrels across the OECD, both crude and product, which is a pretty sizable amount. That's about 10%. And they have a window that's going to last. It's about 6 to 12 months. I think most of their objectives should be met within a 12-month time frame. And I think the real risk that OPEC's facing is that demand falters. And it goes back to the point that Martin Feldstein's making. He said, well, it may affect some markets, but that's their problem if we put a border adjustment tax. Guess what? That's a pretty big problem for a lot of emerging markets out there. And remember, 100%, and I'll be clear on this, 100% of demand growth in oil is coming from emerging markets, which are the very same markets that could be negatively affected, very negatively affected actually, by a border tax.
Yeah, if we get trade wars, that's where your demand is going to go. So how much does it have to slow to materially impact the OPEC cuts that we are seeing?
Well, so we are looking for a deficit of around 600,000 barrels a day this year. And our demand growth number is around 1.2 million barrels a day. So if demand growth drops in half, we will see very little effect of OPEC cuts, and we'll see no inventory declines throughout the course of the year. And frankly, have we had this kind of growth rates before? Absolutely. Not recently, not in recent years, where we've had pretty good emerging market growth in oil, but we've had them back in the 90s, back in the 80s, to your point, right? So if we end up with a very fragile emerging market outlook, that's where I think the view that we have, which is oil is going to rally to 70 bucks, simply because we have this reflation pressure and we have this outlook for stronger growth. That's where I think, and we have the OPEC cuts, that's where I think that the outlook can change. So that's the key risk. And it worries me a little bit because it seems that the incoming administration may not be necessarily pondering all the effects that the wars are having on this emerging market. Look at what's going on with the Mexican peso.
Right.
I mean, the Turkish lira, a bit of a separate story, but also had a massive move down. This is the kind of thing that gets me really anxious, and that's what I did my PhD dissertation on many years ago. So I've seen it in the 90s very, very closely, and I've studied in detail, and I just don't think a lot of emerging markets can withstand. I disagree with Martin Feldstein. I don't think many emerging markets can actually withstand the pressure of a 25% appreciation in the US dollar.
So that's the external issue of a border tax adjustment. What about the internal issue? What happens to WTI prices here in the U.S. if we do get that border tax adjustment?
Well, and naturally, U.S. commodities are going to go up. It's not just WTI. Pretty much every commodity is going to go up relative to international commodities by the amount basically prescribed by the tax.
That's like a 20 to 25% increase in domestic oil prices.
Well, and this is where I actually agree with Martin Feldstein. I think prices globally will probably go down. WTI may not go down as much because the negative effects on growth elsewhere will prevent the price of WTI from going higher. I think it'll be more other commodities actually coming down on the back of that. So that's my concern, and that's where I think OPEC's strategy can falter if the pressure from day one becomes a focus on trade and on emerging markets and on delivering a very strong dollar. Remember, we've already had a big run-up in the dollar. It's all been around larger fiscal deficits, higher interest rates in the U.S., and that's what's led the run-up in the USD. But if we have on top of that all these trade barriers, I think you're going to have a lot of dislocations that will persist for a number of quarters. In the long run, could things be okay? Sure. In the long run, everything is fine.
Right.
But well, in the short run, it'll be painful.
So if your upside target is 70 that is at risk, what would be the downside target?
Well, we don't really have a downside target, but I think under we're talking about emerging markets potentially going into recession here, and every time I wake up and I look at some of these emerging market currencies dropping by another 5 or 10%, and it just makes it hard for me to sleep because I think, well, maybe, right? So that's really the issue, I think.